Good afternoon, everyone. It's a stormy day in Mumbai, the monsoon starting. I'm really happy to be speaking with you again. I know this has been a tough phase for everyone as the country battles COVID. This session is called Tough Choices, this or that. And we're going to help you think through the toughest decisions you will need to take in terms of personal finance over the next few months. But before we get to the tough choices, which is the report authored by the BankBazaar team, I hope all of you are doing all the straightforward things we need to do in order to protect ourselves in this phase. If you have the privilege of working from home, I hope you're minimizing social contact. If you do have to step out for work, please protect yourself with a mask at all times and wash your hands regularly. I hope everyone is staying calm. Yes, this is a tough phase, but we will get through it. And we will get through it learning and becoming stronger. I hope you're exercising. I hope if you do meditate, you're meditating to stay calm. I hope you're maximizing your time with your family. I'm spending a lot of time with my 2-year-old daughter and really enjoying it. I hope all of you are also taking the opportunity to do that. I hope all of you have made the simple decision of minimizing your discretionary spends. Everyone should be spending 30% less through this tough COVID phase. Now that all the simple things are out of the way, I want to talk to you about a report that the BankBazaar team has written about the 3 toughest financial choices that we are going to have to make through the COVID phase. The report will be downloadable on LinkedIn on the events page, so you should download and you should read it. The report is done with really nice examples, which is to help you understand how to make these decisions. Of course, while the report takes into account prevailing market rates, you must understand everyone's situation, tax rate, instrument is different. So you'll need to calculate for yourself, which is a disclaimer. But the report itself is very, very interesting. So without further ado, I want to start on the 3 toughest questions that you will need to answer. And I'll start with question number 1. So many of the 40 million registered consumers in BankBazaar ask us this question. Should I continue with my debt mutual fund or move to a fixed deposit? So I had a gentleman come to me and say that I've had my debt liquid mutual fund, which I'm earning 6% for the last 2 years. I'm considering moving that to a bank fixed deposit because I want to be with the bank in these COVID times. Should I do it? Now, before I answer the question, and I'm going to put up the report to help you answer it, just let me give you some background. The currently prevailing rates on a fixed deposit and a high yield savings account is between 5 and 6%. High yield savings account, there was some news about this, are currently earning as much, if not slightly more than a fixed deposit. So let's say 6%. However, this interest is taxable. So once you deduct your income tax, your interest earned on a 6% fixed deposit or high yield account, if you're in the 30% tax bracket, is roughly 4.2%. So that's one number to keep in mind. Post-tax, your fixed deposit at 6% is actually getting you 4.2%. The second point to keep in mind is your liquid mutual fund is also earning 6% over the last year. However, if you hold that debt mutual fund for more than 3 years, you get the benefit of lower tax. It gets taxed as long-term capital gains with indexation. It varies by example, but roughly, let's say it's a little less than 10%. So there's a significant benefit in terms of taxation. So your 6% liquid mutual fund return post-tax is actually 5.6%. Remember this number. So your post-tax return on the fixed deposit is 4.2%. Your post-tax return on the liquid mutual fund, because of the tax benefit, only if you hold for 3 years is about 5.6%. Now, keep in mind, if you don't hold the debt mutual fund for 3 years, this benefit disappears. So this benefit of 4.2 to 5.6 extra interest disappears if you don't hold the fund for 3 years. Now, let's go to this gentleman's example. I'm going to share a table which is from the BankBazaar Tough Choices report. Please give me a second. So I put the report out there. So here's the calculation we did for the gentleman. If the gentleman had 1 lakh in principle and was holding that liquid mutual fund at 6%, they've earned interest over 2 years. Now, if this person holds the liquid mutual fund for 3 years at 6% return, the net corpus value at the end of 3 years is 1,17,000 rupees 900. So they would have made 1,17,900 on 1 lakh if they held the 6% liquid mutual fund for 3 years, and this is a post-tax calculation. However, interestingly, if I break that mutual fund in 2 years, lose the benefit, shift it to a fixed deposit at 6% for a year, my corpus value post-tax after 3 years is 1,13,000. Now, these are the two numbers you need to remember in this example. If I hold the liquid mutual fund for the complete 3-year period, because of the tax benefit, 1 lakh became 1,17,900. If, however, I broke the liquid mutual fund, moved to a fixed deposit in the 3rd year, I don't get the benefit. My corpus at the end of the period, 3-year period, is worth 1,13,000. So I've made 4% less by switching out. Now let me stop sharing my screen. Now the question is, 4% over a 3-year period difference in corpus is about 1.3% per annum. Should I switch? Now the answer to the question is that depends on you, right? Do you value the safety or the peace of mind you get in a bank fixed deposit and earn 1.3% less per annum? Or would you prefer to stick with the liquid mutual fund and make that 1.3% per annum or 4% extra over a 3-year period? That's a choice you need to make. And given the current circumstance, we're all reading the news. It's a choice you can think about, discuss with your family, your advisor, and make. Now, keep in mind, this example in the Tough Choices report is on a liquid mutual fund. You could do the same calculation on a short-term mutual fund. You could do it on a different debt mutual fund, which earns higher interest. So this 1.3% is the difference between the liquid mutual fund and the bank fixed deposit. The delta might be greater if you talk about a slightly more risky debt fund, but that is the classic risk reward nature. The more risk you're willing to bear, the higher the return you're going to make. So the point I want to leave you with is, if you do decide to switch from a debt mutual fund to a bank fixed deposit, please calculate the difference in tax. And the example we just showed you, there's a difference about 1.3% because of the tax implication for this particular person if they shift from a liquid mutual fund to a fixed deposit, which works out to 4% over a 3-year period. And you can take the decision. Now, let me move to the tough question number 2. Now, when choices are easy, you should always pay your SIP, you should always pay your EMI, even during the moratorium. If you can do both, do both. No questions about it. But let's say you're faced with a tough choice. The tough choice is, and this came from one of our readers, the person has 1 lakh available and they're trying to decide whether to continue their SIP or whether to pay their loan EMI. And they can only do one of the two. How do you handle this tough choice? Now, again, let me take you back to some of the numbers we calculated in the first example. A 6% bank fixed deposit post-tax is giving you about 4.2% if you're in the 30% tax bracket. A low-risk liquid mutual fund is giving you about 5.6% if you hold it for 3 years. So we're talking about 4% to 5.6% post-tax. But keep in mind, your home loan EMI is probably about 8%. Your car loan EMI or interest is higher. Your personal loan EMI is 12%, interest is 12% or above. Your credit card interest is even higher. So if you have a choice between taking that 1 lakh and putting it in a fixed deposit or a liquid mutual fund, or putting it towards repaying your EMI, even in a moratorium, I think it makes sense to pay off that 8% or higher debt and pay off the EMI than saving the money, making use of the moratorium, but paying that 8% or higher interest. Now, you can always come to me with a question saying my investment is making more than 8%. Now, keep in mind, you might be right, But for an apple-to-apple comparison, in the BankBazaar Tough Choices report, we have to take a risk or a low-risk investment, which is the 6% FD earning 4.2% post-tax, or the 6% liquid mutual fund earning 5.6% post-tax. We have to compare that with the EMI interest rate you're paying on your loan. So yes, if you're willing to take higher risk, you might make higher return on the investment. But in an apple-to-apple comparison, we have to compare a low risk or as low risk investment as possible with the loan EMI, which is what we've done. So if you have a lakh and have a choice between your SIP and your loan EMI, we feel you might be better off paying the loan EMI. Now, let me make the question tougher. And we've discussed this in the BankBazaar report. Imagine that it's not 1 lakh you have in hand, but you have 1 lakh in an asset, a fixed deposit or a liquid mutual fund. Should you break that to pay your loan EMI during moratorium? So I've made the question tougher. Now, the additional variable now is there's typically a cost to break that existing asset. Now, the cost either might be a 1% fine on breaking the FD, or it could be an exit load if the mutual fund is less than 12 months. And it could be the tax benefit you lose if you hold the debt mutual fund for less than 3 years, which we spoke about. It's all in the report. We spoke about it in the first example. So there could be a 1-2% breakage fee. Now, again, this is a tough choice. You should calculate for yourself. But what we find is even if you were to break that FD, which is earning you 4.2% post-tax, even if you were to pay the fine, you might be better off liquidating that asset and paying off the loan EMI, which is being charged at 8% or above, even during the moratorium. So this is the second tough choice that we've addressed in the BankBazaar report. Please take a look at it. We've tried to use easy examples using prevailing market rates. And obviously, every person is different. Every person is in a different tax bracket. Your instrument that you're holding is slightly different. So you should take control of your finances, work out the numbers yourself. But this gives you very powerful tools to answer these tough questions. And these are the kinds of tough questions our 40 million consumers have been asking, which is why we wrote the BankBazaar Tough Choices report. Now, let me go to the third tough choice. So the third tough choice is, should I pay my insurance premium or my loan EMI during moratorium? Now, please keep in mind, during these COVID times, it's very important that you have health insurance so that the hospital bills can be paid if you do get COVID or if you get any other condition. It's very, very important. Health is critical at this stage. Also, term insurance is very important because if something unforeseen were to happen to me, I want my family taken care of. I want to know that for 5 to 10 years, they don't have to worry about anything. So your term insurance is important. The RBI has offered you an excellent benefit of a moratorium. If you have a choice between paying your insurance premium and making use of the EMI moratorium, I am advising you, pay the insurance premium. You do not want to be without Mediclaim. You do not want to be without term insurance during this COVID crisis. So pay that insurance premium if you have to choose between the insurance premium and your EMI during the moratorium. However, and this is also covered in the report, keep in mind, if you make use of the moratorium, interest is being calculated on the loan through the 5-month moratorium. What does that mean? So the report has a really nice example. We take a 50 lakh home loan and we say that if you miss or make use of the moratorium in the first 5 EMIs of your 20-year loan, because of the accumulating interest and because the impact is highest if you make use of the moratorium during the early part of your loan, you could end up having to pay EMI remaining the same, 30 extra months of EMI because of making use of 5 months of moratorium during the first 5 EMIs. So interest is accumulating. It will have a bearing on the additional months in which you pay interest, assuming the EMI is kept constant. But BankBazaar has done this really nice calculation. We call it the BankBazaar bounce back. It's been discussed widely in the media. It's covered in the report, where we say there's a simple bounce back formula. It goes as follows. If you don't have to, if you can pay your EMI during the moratorium, please pay it. If you have to make use of the moratorium, then calculate 1.2 times of the EMIs that you didn't pay during the moratorium, 1.2 times of that value paid back as a single lump sum bullet payment within 12 months. I repeat, the BankBazaar bounce back is take all the EMIs you missed in the moratorium, calculate 1.2 times that value, make a single bullet payment within 12 months of making use of the moratorium. What this does is it automatically brings your principal in line with the original schedule, and you don't need to pay any extra EMIs or any extra months of EMI on the loan. So it's a bounce back. It essentially brings you to an as is situation, but obviously you're paying 1.2 times of the EMI instead of one, which is the cost of using the moratorium. But the benefit is by paying that 1.2 times your EMI as a single bullet payment in 12 months, you can rationalize or bring your outstanding principal on an as is scenario, as if you didn't use the moratorium. This is the BankBazaar bounce back. So the answer to the third question, if you have to make use of the moratorium, make use of it, pay your insurance premium, but always remember to bounce back, make use of the bounce back so that you rationalize your outstanding loan amount. Now, if there is no moratorium, say let's August 31st is done, moratorium is over, please keep in mind your loan EMI is an obligation. Unlike a lot of other things we're discussing, a loan, a credit card repayment is an obligation. If you do not pay it, there are serious consequences. The consequences are in terms of fines, additional interest, being reported, and your credit score going down in the credit bureau. Obviously, your credit score, there's no impact if you don't pay during the moratorium. I'm talking about after the moratorium. If you don't pay your EMI after the moratorium, your credit score could go down. So credit score is very, very important. I'm saying that because in these tough times, banks want to lend to people with a higher credit score. There are a lot of home loans out there which are cheaper. If you have a credit score over 750, if you have a credit score over 800. Your credit score is a proof of your prudent handling of credit. It is very, very important. Please keep track of your credit score. Please make sure your credit score remains good and always protected, because it becomes even more important during this COVID crisis. So with that, I've answered the three tough questions. All of it is available in the BankBazaar Tough Choices report. I know I've covered a lot of data points. I try to keep it as simple as possible for this show, but all of the illustrative examples are there. You can download the BankBazaar Tough Choices report on the events page. The goal is to distill the tough questions we've been getting from our 40 million customers, from the various financial journalists we've been talking to, and put it out in an easy to understand report so the common man, the consumer, can take control of their finances, do the calculations for themselves, and decide on these tough choices during the COVID phase. I hope you found this BankBazaar live interaction useful. I hope you'll find the Tough Choices report authored by the BankBazaar team, and I think they've done a fabulous job, useful. We have a lot of exciting shows coming up. So next week, I have one of India's top entrepreneurs. He's also a very prominent investor now, and he's going to be talking to us about winning in the crisis for startup. The week after, I have a very respected financial journalist talking to us about the tough choices. So I hope you enjoyed this show. Please like and follow my LinkedIn page. We put out a lot of interesting information out there, which I hope you'll find helpful. Thank you for watching this show, and everyone, please stay safe. We will get through this. We will learn how to get stronger, and we will manage through this situation. Stay positive, stay calm, stay focused. All the best, everyone. Stay safe. Take care.